Dr. Shane Oliver, AMP from Sydney, joins us on the show for a first opening salvo here. Dr. Shane, good to see you. My good friend, we saw what, a week and a half, 2 weeks, if you strip out the weekends, of gains in the markets. A lot less conviction today. Are we seeing the beginning of a tumble and people waking up and going, oh my God, I punted those stocks too high?
I think markets did run very hard over a 10-day period there, and I guess after such a run, which was in excess of 10%, it's inevitable you're going to have a pullback at some point, probably of the order of somewhere between 1 to 5% over maybe the next couple of days. But I think the broad picture still remains very favourable. The profit results coming out of the US have proved to be far better than expected. Economic data around the world still pointing to a recovery later this year, and investors are only just starting to realise that we are heading towards a recovery, and there's still a lot of money sitting on the sidelines. So whether we have a bit of a correction or not, I don't know. I think we possibly will, but I think that the broad trend in markets will remain up, and by the end of the year they'll be substantially higher.
I have never heard you, Shane, so green shooty talking. Wow, where did this come from? What about the fact that even though the bottom line is impressing with the earnings rollout in America, the top line is another issue, could have implications down the line? I mean, can you keep up this momentum of corporate earnings? We're still in a downtrend. We're still going to be down 15, 20, 25% if you go on a year-on-year basis with a lot of these reports. I mean, people were so down. No wonder the mood is much improved.
Well, it doesn't require much of an improvement. When confidence is so negative, it only requires a slight improvement to get people buying into the market and therefore pushing the market up, which is what we've seen here. It's true that so far, when you look at the breakdown of the earnings surprises, about 75% of companies have surprised on the upside in terms of earnings, but when you look at revenue, it's about 50%. I wouldn't expect that the pickup in revenue will start to appear until through the second half and then going through into the early part of next year, because the reality is the US economy is still in recession. The global economy is still in recession, at least as at the June quarter, and that is still obviously being a bit of a drag on revenue figures for companies. But the flip side is that when you look at leading indicators of economic activity, such as the business confidence measures, consumer confidence, you've got the US Conference Board's leading indicator up 3 months in a row. Historically, when you have 3 months in a row of gains, that inevitably, or always, usually points to a recovery down the track. And similar story right around the world. So my feeling is that, yes, so far the surprise for earnings has come in terms of cost savings, but there's a huge leverage in there. If you go back 6 months ago, companies were starting to factor in some sort of depression going forward, as were investors. Now, of course, they've been surprised on the upside, but in the process, they slashed their costs, and they're now getting a huge leverage on the upside.
Yep. Big question is, do we learn our lessons from history?